Hello everyone, welcome back to the DTT Volatility Grid lecture series. In this lecture, we will be going over volatility intervals and understanding why they are very important when it comes to trading, DTT, and the framework around it. Now, the three main components that we will reflect on are essentially predicting possible continuations or reversals. We're not trying to predict the markets, let's make that clear, but instead we're potentially expecting some reversals or continuations of a current trend. At the same time, we can also use it for volatility spikes, and this tends to happen pretty often surrounding these intervals. And last but not least, we can use it for risk management. We can adjust our position size based on the volatility of the interval. So we'll be going over all of this. On the indicator, whether it's the intraday or the weekly Pro Plus, you will see the time interval settings section. As we can see here with the start and end, we can turn the model on or off essentially. The start and end is essentially turning on or off the model, the beginning point, and the end point of said model. So I can turn this on or off if I want less noise on the chart. Same thing with the intervals inside the model. I can turn those on or off as well. Or I can change the shade of the color, change the opacity, and or change the color as well. I can also choose what type of line I want to have, whether it's solid, dashed, or dotted. Very customizable. Now, according to the DTT framework, it's very simple. For these intervals, I personally like to see if there's going to be a continuation or a potential reversal. Now, I like to have these intervals on the inside off, as I have these memorized by memory now at this point. However, around these times, in this case 1034, 1044, and 1055, I personally like to see and observe, will we continue the current trend? And if not, are we going to have a reversal? This is one of the main aspects of the framework when it comes to the time intervals. Now, this becomes important because if we are looking for trades and we are in a statistical discount, more on this later, when it comes to AMRP, I could potentially look for my price model in that area, but not just in that area, at a specific time. So at 10:55, I could be watching the chart with my eyes wide open, looking to see if my model is going to present itself. And if it doesn't, well, that's okay. I can wait for the next interval or wait for the next setup, correct? Nevertheless, these intervals are pretty important. As we can see, many times they tend to have reversals surrounding those intervals. Here's a perfect example of that. Never quite takes the low down here, but instead has a reversal at 10:55. Thereafter, it has a reversal up here, and another one shortly after. The next aspect of the framework is going to be volatility spikes or injections. Now, another popular concept when it comes to these intervals is that very often, with or without news, you tend to see a volatility injection at these exact times. As we can see, 1:40 p.m., there was a random, maybe not so random, spike in volatility. A very large candle printed compared to the rest of the candles that took place beforehand. Similarly here, 1 minute prior to 1:20 p.m., which is an interval inside this model, we saw a volatility injection. Now it's important to understand that this is not always going to be just like this. However, it's important to keep your eyes peeled just in case you're in a position and you could potentially see a volatility spike. If it works in your favor, great, but at the same time, it's important to manage risk accordingly. And that brings us to the next framework aspect. It's meant to have a risk management framework as well as a potential time stop. Now, a lot of traders tend to use time stops, and that's essentially at a specific time if the trade is not panning out according to the amount allotted time, then it's best to minimize risk, take partials, or perhaps just ease off the brakes, correct? So in this example, if you were to go long here around this Asia model, you see a nice uptrend to the buy side. And looking at specific liquidity pools or perhaps AMRP zones, you can take profits along the way. But if you are holding any runners or any extra contracts, In this case, at each interval, as we can see here, I would personally like to see a continuation. And instead, if we see a reversal and a strong spike back down, then I could maybe potentially decide, you know what, I'm going to take the rest of my position off. It has had sufficient time and it looks like it's running out of time. As we can see here, after this reversal, it just decided to continue the downtrend all the way until the end of the model. So understanding this is very important because you can adjust your position size based on the volatility or possible reversal of the interval. And during high volatility periods, as we mentioned here, you can also trade smaller or larger depending on your risk tolerance and your account size. And during low volatility periods, you might just ease off the brakes and come back for the next model. This has been a very brief lecture on the time intervals. Very simple, as we can see. It's just three main components. And the next lecture is going to be on time-based liquidity, also known as the previous model highs or lows.